Labor Smart Inc.'s Q1 earnings report. And, you know, I've been around the stock for a long time. I've been in the stock since 2001. I've seen everything possible with this company. The good, the bad, the ugly, the horrific, the very horrific. But as we'll get into, this is the first time in a long time where I'm a lot more comfortable where things are at. And it's I feel a little bit more cozy. Doesn't mean that LTNC is going to succeed in the long run. It doesn't mean that we're going to get our money back. But this is the first time in a long time where I feel like I don't have to watch this as a hawk. I feel like this is at least on train tracks now, and wherever it's going to go. It's out of my hands, which kind of settles me a little bit. And so just a couple points I do want to bring up from the filings is the liabilities are down, which is good. We also have a positive net cash from operations. And the not so good thing here, we have 17.5 billion shares outstanding. And, you know, Mike Holly finally is retiring his 500 million shares from the GoFast deal, but there's a lot of dilution that's happening as well. We have an authorized amount of 25 billion that we can get up to. And, you know, I believe that the company is going to use a lot of those. I wouldn't be surprised if we get close to 25 billion. Now, I would be a little disappointed and upset if they did try to have a vote and raise that authorized share count to more than 25 billion. And so those raise red flags for me, because that at that point, that means we're still growing without using any revenue from our operations, and we're just taking on a lot of debt. So hopefully that does not happen. And so when we look at liabilities, if we go over here, we see in 2024 we had total liabilities of 35 million in 2024, and then to start 2025 we have liabilities of 29 million. So that was a 6 million decrease in liabilities year over year thus far, and so that's a positive. You know, at the end of last year, going into Q3, Q4, we picked up Illumination, Legacy, GoFast, Krager. So there was a lot of growth, and there was a lot of debt used to get that growth, to put us on a scale of being a distribution company and not just a beverage company with locked in as we were before. And so that is good to see, because at the tail end of last year, that's when our liabilities were at the highest because of all those things. And to see that in 2025 to start to go down, it's really nice. You know, you see the current liabilities, you know, it's going down. What else we see? A little bit down on the long-term liabilities, but a lot of it is coming from the current liabilities. And let's see. Accounts payable and accrued liabilities, that's down almost 2.5 million. Due to related party, it's down almost 1 million. So I do attest that a lot to what Greg has been able to do. He's, as a distributor operator in his past, obviously the success has been a little bit shaky, but he at least has the experience to build upon his last failures, and hopefully to make this successful. And so, you know, we've talked about a lot of shares talked about a lot. We got to get the cost down. We got to get the liabilities down. Got to get the sales, the cost of goods sold down, which is still an issue. As we go over here on the 3-month period, we had sales of 3.3 million, almost 3.4 million, but the cost of sales was 3.3 million, right? And so we had a gross profit of $40,000, $39,000. And so I can't sit here and say that's sustainable, because it's not. Obviously, I understand there was a lot of costs that came into play to get these sales, because we bought Krager, we're buying infrastructure, and so that all goes into the mix. And when those start to even out, the cost of sales are going to go down per unit. So I'm not worried about that yet. But if I keep seeing cost of sales matching our sales throughout the next quarters, then we could have a problem, because that's not sustainable. We have to make money. We actually have to make an operational profit. We might not have, in general, overarching profit with everything, but operationally, it's gotta be net profit for sure, and it's got to be a lot for us to survive. And so now let's look at some of the expenses from 2023, 2024, and 2025, because that will give you the story of where we've been, right? So we have to look at the last 3 years. We have to look at the last 3 years here. And so when we're looking at the last 3 years, so we have 2023, we had expenses of $430,000. And no, it's good to note that this is when we were making no money, right? So in 2023, there was really no revenue to our name outside of locked in. That's all we had. And so to have those operating expenses was a killer. That was super high. You're paying selling and general administration. You're paying professional fees from lawyer fees and stuff like that, and advertising and marketing. You're paying all that, and to not see any results. If we did not switch over to being a distribution company, actually generating revenue, this was unsustainable. So you have to keep that bookend in mind, where we were at in 2023. Now going over to 2024, we got Pink. We linked up with Brad and Illumination to make this a distribution company. So it was a little bit different of a feel that we had before. So where was that at? And so payroll and benefits, because obviously we grew, benefits had to come for people within the operation. So we almost had $500,000 in payroll and benefit for expenses. Selling and general administration nearly doubled from where it was in 2023. Professional fees, they are actually lower, which is nice, because over time, the legal fees started to lessen, because we're not having as many lawsuits. Thank God, right? Advertising marketing was cut in half, but that could be going up again depending on where the ramp up is. Amortization, depreciation, so those add almost 300,000. And so the total operating expenses for Q4 in 2024 was $1.4 million. And so that encompasses, everything, right? Because we got Krager, we got the Krager revenues in November and December. We already had Illumination by Q3. So there was a lot of expenses of just that growth that kind of just plopped on Q4. And so now we're looking at Q1 2025, where our expense is going to be. And now you have to understand, this is quarter by quarter. So you have to extrapolate this out by 4 quarters, right? So what we did in Q4 for expenses was 1.4. So where are we at in Q1 2025? Because now you're going to have to see, what does that scale out to be? And so it's nice that the total operating expenses dropped down 300,000 to 1.1 million. Payroll and benefits dropped from 495 to 439,000. So that's nice to see. Cut some people off. The selling and general administration, again, that's another good one. That's $100,000 off. So we're cutting costs there. And you have to understand, when we bought Krager, there was probably a lot of trucks and a lot of people that we didn't need. Since you're consolidating networks, you don't need a whole lot of that. You just need the facility. We can use the Illumination truck to travel to Krager to pick up whatever it needs to get to the next location. We don't need Krager to have its own trucks, or a lot of its own trucks per se, because we have, a combined operation now, right? So that's good to see. Advertising marketing, that's going to go up a little bit more, obviously, because we're going to grow with GoFast, Locked In, and whatever we have under our brand. Professional fees. One thing that about the lawsuits, and you have to look at the filings. There was a lawsuit that Illumination grandfathered in for Black Rifle Coffee. So, in the history of LTNC and all the lawsuits, it seems like we can never get away with it. And it did not, and we did not get away with it with adding Brad and team. But hopefully that can get to a resolution soon. Some trademark issue with Black Rifle Coffee and such. So we saw the professional fees once again rise up, but not as bad as they were in 2023 with no revenue coming in. And so overall, that's good to see. These are the trends you want to see in your company. This is a flat out turnaround play. Like, there's no two ways about it. This is a turnaround play, and you need to allow it to have time, right? And I know it's tough for people to be patient since we've dealt with a lot of crap in the past from previous managements and such, but we have to give Brad an opportunity to see if he can actually do this. And right now is looking like it's possible. And so also, let me go back to what it looked like from Q1 to Q3 in 2024, because that also gives us a nice story, right? And so this is what we did in Q3, and this is what the total was for all the way up to for the 3 quarters. So in Q3, when we got all those expenses, that was about $1 million in expenses, right? And then at the total, so we had about 700,000 in Q1 and 2. And so that alone was 1.7 million in expenses. Then you add the 1.4. So there was a lot of things, and there's going to be a lot of dead money too. So it's good to see that that's going lower. Gematria wise, we have LTNC, Colorado Distribution Network. That's 333 English ordinal. That's 117 in English reduction and 153 reverse reduction. So we have some very powerful numbers here. LTNC right now is primarily in Colorado. That's where Krager is, Illumination is. That's where we're starting our location. So that's where we're starting. So that's good to see energetic wise. Now let's look at where the fair value of things are, right? I like to look at what the value of the stock is depending on certain metrics. And so right now, there's a lot of things going on with this distribution company. I could add in assets, but with the assets, you have to understand a lot of it's already with debt. And so we already know that's an issue. So what I really want to look at is the revenue based off the share count, right? You normally do this with tech companies because they're capital light, but we're a penny stock, especially we're a beverage company. And so I'm just going to allow the capitalized part of the equation to the wayside right now. And we're just going to look at the revenues, right? And so with the PRs we've gotten in the past, they said that Krager did 22 million in 2024 of revenue. I don't know what their expenses were. They could have had $50 million in expenses, only made 22 million. I'm focusing solely on the revenue. So if we took the 22 million in revenue, if we just did as a whole what Krager did last year, I'm just adding everything in, right? If we do 22 million as a company in 2025, no matter how it gets there, and we divide that by our 17.5 billion share count, we're looking at a stock price of 0.00125. So, we're at 0.1. So we've been at 0.1 for a long time. I thought that was the bottom. We actually hit trips not too long ago, high trips. I think we're mid trips right now and in the 0007 range. But if we get to the 22 million spot, we're at least in the double in the 0.112 range. Now, This is probably what it really is. What the fair value I'm going off now. And if you look at the stock price and where it's at right now, it actually goes in line. So if you extrapolate out what we did in sales for the first quarter of 2025, we did 3.3 million, almost 3.4 million. So say we have a roundabout number of, we do those 4 quarters, that's 13.2 million in revenue, right? Now, I don't know what's the rest of the year is going to hold. We could ramp revenues really fast, you know. I don't know. We'll see. But I'm just going off what I believe is predictable. So if we take that 3.4 times that by 4, we get 13.2 million in revenue we'll do this year in predictability. And so that puts us at a stock price of 0007, 00075, which if you look at the stock price today, right now on May 31st, that's where it's at. And I think that's a fair assessment, because even though, you know, this is a penny stock and Wall Street's not looking at it, if anybody serious is looking at it, they can tell that, right? It's simple math. It's sitting around that price. So I don't believe we're undervalued by any stretch. And, you know, I don't think we're overvalued by any stretch either. I think there could be an argument either way that we could fluctuate either way. But, you know, I think I'm comfortable saying that we're a mid-trip stock. We haven't really proved anything to require more yet. And so that's where I'm at. I'm really focused on the distribution company right now. And if GoFast and Locked In Next Gen turns into something, those could be growth drivers. But am I sitting around hoping and praying those are going to turn into something? No, because you know, I have no previous experience with, especially Locked In, proving that it can be done. I love the products. I drink it, you know, hydrogen water, nootropics, and you know, I don't want to, you know, I don't want to single anybody out or anything because this is such a process, but I really do question where Locked In is going and where the next gen side is going. I really do. I question the business tactics. I question the business strategies. I question the focus on certain products. I question a lot. And if we were still a beverage company without all this other stuff going on as safety, I think it would be a wrap. I don't believe we would be surviving right now. And while I wouldn't sell, that would be my selling point. I would keep the shares, but I would literally, you know, put them somewhere else where I wouldn't think about it, because I just don't have a whole lot of faith in the Locked In side. And it sucks to say. And, you know, I put it on record, is if push came to shove, if Locked In side of things cannot figure it out after so long, maybe it's best that we stop putting resources into it. So I just got to be transparent there. I just am not happy on the next gen Locked In side of things, because I just don't think the business strategy, the business plan in general has been good. I'm willing to be proven wrong. I hope I'm proven wrong. I'm not wishing on anybody's demise, but I just got to call a spade. You know, I study businesses for a living, and anybody on that side of things can try to defend themselves, but the facts are the facts. And so I challenge everybody on the next gen Locked In side to stop talking and actually get work done, you know. So that's where I'm at on that. And so, you know, I have my money where my mouth is. I have 2,222,022 shares of LTNC still. I'm down 90%. So I have about 20 grand in this stock. I've had 20 grand in the stock for a long time, and I will continue to do so, and continue to provide information as information comes. Before we get to my other things, I do want to read off the letter that Brad had for the congregation, because it was pretty cool. And so I'm going to share my screen. I'm going to share this tab. And so we're going to go over to my Twitter, and we're going to read off the letter to shareholders that Brad gave us. And that's going to be the last of LTNC after I go through this letter right here. So Labor Smart Inc., Shareholder letter Q1 2025 from the office of the CEO. Dear shareholders, as we close out the first quarter of 2025, I want to take a moment to acknowledge the progress we've made in the path ahead. The transformation of Labor Smart from one single brand, direct-to-consumer business, into a diversified multinational beverage and wellness conglomerate is well underway. Though the numbers in this quarter may not fully reflect the scale of our ambitions, they reveal a company gaining real momentum, built on strategy, structure, and execution. Turning the corner. Q1 revenue surged to $3.39 million, representing a year-over-year increase of more over 1,300%. This explosive growth didn't happen by accident. It is a direct result of our shift in vision and the disciplined execution of our growth through acquisition strategy, which I've talked about in the past. There's pros and cons to growth acquisition. Through the acquisition of Krager Mercantile, we've immediately expanded our footprint into over 9,000 retail locations. This was not just an acquisition of revenue. It was an acquisition of infrastructure, relationships, and access. We now control a critical piece of the supply chain, giving us the distribution backbone needed to build and scale multiple brands under one roof. And I like how Brad notes that this wasn't just an acquisition of revenue. Obviously, it's not. We did not pick Krager just for the revenue, but it was a signal that we actually finally had revenue, right? We had something to actually generate revenue, which we haven't had before. So I want to make that distinction. No, it wasn't just for the revenue, but as you see in the surge of money made, we weren't making any before. And so that is something that should be of note, right? Of course, it was more about the infrastructure, but we have something on paper now. From locked in to GoFast and more. There's a lot of people out there saying, oh, is GoFast not a part of the company? Did the GoFast acquisition not go through? Guys, the CEO talked about it, when this happened. So just follow the context clues, right? Our roots as a single brand direct-to-consumer company served their purpose. And that could go for GoFast or Locked In, because GoFast was a single brand company before. But our future lies in building and acquiring high-margin brands, developing channel-agnostic distribution strategies, and unlocking institutional and B2B revenue across independent stores. Unlocking chain retail, school districts, hotels, and on-premise locations. We've paired this innovation with a refreshed marketing push for GoFast Energy, align it with an omni-channel growth strategy. These efforts signal a focused intent, not just to participate in the consumer's goods, but to lead it. Hope so. We got to do it, right? I'm all for this, but we got to do it. We got to do it. Managing the growth curve. We are under no illusions. Turnarounds are difficult. Growth comes with complexity, and complexity often comes before profitability, which this is very complex. This is why every quarter I sit down and distill it all for people who have trouble grasping it. I've been studying stocks for a long time, over 5 years. I read annual reports from the 1800s to learn how to break down the complexities, especially of a business of distribution. We close the quarter with a net loss, but it's critical to understand why. Our expenses reflect strategic investments in personnel, marketing, legal work, and infrastructure required to scale. We are confident that these short-term costs will yield long-term returns. And, I have to keep telling people, because there's people out there that believe that, Illumination wasn't a bad acquisition, like Illumination was a bad deal. But I have to keep reminding people is Illumination was never a flat out distribution deal. We acquired Brad, Scott, and Sam and GoFast essentially. LTNC with Illumination acquired personnel with experience in this space to take us where we want to go. That's what we paid, so, what we had, and it just wasn't the message wasn't conveyed that way. So what a lot of people thought Illumination was what actually Krager was. And I think what they did was, when Tom and Brad sat down of making this deal happened, and when we got that that PR in October for Q3 of saying, you know, we're hoping for 25 million in revenue, but no stipulation on when it was coming, if it was coming, how that looked on the paper. I think they talked about how Brad, one of his first initiatives was going to get Krager Mercantile for that 22 mil. And so that's what I think what happened. Again, the messaging was off on that, but I think that does align. At the same time, we've been aggressive in cleaning up our balance sheet, carefully balancing the cost of expansion with a careful blend of equity and debt that will be offset by significantly increased revenues and improved margins that will scale with profitability as we strategically attack liabilities, liabilities in dilution with this transformation of this company. This is all part of a long-term strategy that will make sense in the coming quarters. We remain committed to thoughtful capital deployment. While some dilution is necessary to fund key acquisitions and partnerships, shareholders' value remains the top priority. We will create a strategy and eventually execute the plan that will enhance the cap table while improving the value to the shareholders. Looking ahead, Labor Smart is no longer a company with a vision. We are a company with traction. With each quarter, you will see further progress, more revenue, more brands, deeper market penetration, and growing alignment between our operational model and financial performance. Our North Star is sustainable profitability, and while that won't happen overnight, it will happen with discipline, execution, and your continued support. Thank you for believing in our transformation. The journey isn't easy, but the destination is worth it. Sincerely, Brad Wyatt, Chief Executive Officer. So that was his letter to shareholders. And let me bring up what I said to that when that dropped, because I felt like it was true. I've been a part of this company a long time, and I've dealt with a lot of shit. I've just dealt with a lot of bullshit. So when you got a letter like that, I had to give kudos to where it is. So this is what I said. One of the first respectable updates and declarations to LTNC shareholders in a long time. I appreciate this kind of communication. No fluff, no illusion, just plain belly-to-belly talk with the congregation. Execution of the strategy needs to be of the highest orders. And I finally say thank you, because that's what it's about, transparency, predictability. Where are we going? What are the next steps? I don't need grand claims. I just need you to work. I just need you to grind. And so that's where we're at. And so that's where the LTNC earnings report is. To all my LTNC shareholders, if you watch this, make sure if you have any questions, let me know. Put that in the chat. Make sure to like, subscribe, and everything.